All right, welcome back, traders. John Caruso here for the morning of November 7th. We're going to do a quick look in on the market here this morning. Quick overview of our market insight letter this morning as well. First off, we always lead off with the market risk. Market risk in the overnight, we did see export data come out of China that did slow to recession levels of minus 6.4% year over year. Did see industrial production out of Germany in the overnight, also recession levels of minus 3.7% year over year. We are seeing a broad-based slowdown over in China as well as in Europe, and we believe that the United States is likely next. There was also a geopolitical risk headline that came out of the Wall Street Journal this morning. U.S. and NATO will be suspending their involvement in the landmark Cold War arms treaty deal with Russia, so that is certainly notable as well. So on top of the global data slowing in the overnight, of course, last week we did see U.S. ISM manufacturing slow. We also did see the labor data slow as well. We did, of course, also receive the S&P Global Services data that slowed down along 50, not quite in contraction, but getting close. And when I look at the commodity basket this morning, we are seeing the commodity basket lower. Metals are trading lower. We are seeing energy prices trading lower. All of that is consistent with a slowing economy, and that's precisely what we believe we are seeing. We do actually have GDP falling into the red in Q1 and Q2 of next year. And the call that we're making right now is that the U.S. will experience a recession in the first half of next year. So taking a look at the charts right now, I got the S&P 500 up on the board here. We did, of course, see that massive melt up in July. It peaked right at the end of July, broke down in August. We did experience a lower high rally up in here, another breakdown, lower high rally, and another breakdown. And then, of course, last week we did see a 6% rally in the market. Of course, I did not have that in my tarot cards at the beginning of last week. I did expect, we have been looking for a low down in here. We thought it would happen sometime around the first or second week of November, and it did come. However, it came very aggressively, 6%. We did, of course, see a dovish Powell last Wednesday out of his press conference. And then, of course, you follow that up with a dovish labor report on Friday. And then all of a sudden, bad news becomes good news, which I kind of scoff at. I kind of laugh at that idea because bad news is always bad news when it comes to the economy. However, we did see that 6% rally in here. We do think this is probably an important low over the intermediate term. Intermediate term, we're going to say over the next 1 to 2 months, maybe 3 months, where we can experience a choppy upside rally into the end of the year. But the risks certainly pick up out in Q1, Q2 of next year for the stock market. That's how we're viewing this right now from a macro perspective. So ultimately, we did have our traders positioned for the bulk of this move on the downside, booking gains along the way, resetting some sell side strategies on these lower high bounces, and booking gains on the legs on the way down. Now, how are we playing this over the very immediate term? At the end of last week, we were positioning back on the short side for this move, a 6% rally. It's an aggressive move. We think it's a little too aggressive here over the near term. We will see some give back, perhaps down along 4,300 to maybe as deep as 4,250 before we can see another resumption of a little more choppy situation back on the upside out into the end of the year. So that's how we're positioned over the immediate term. We are kind of coiling right around this 50-day moving average. I would not be shocked if it were to push into 44, maybe as high as 44.30, reattack these old highs in here. But then ultimately we do see some give back, perhaps back down along 4,300 before we can see another resumption of the trend higher. But once again, I will highlight the risks pick up dramatically, we think, out into 2024. So, of course, buyer beware from that standpoint. I do have we do have still an overbought signal up here in the oscillator. So that is also suggesting that perhaps another wiggle on the upside before we start to see some give back. That's how we're looking at playing it here over the very near term. Taking a look at the gold market, I'm going to flip over to that because gold prices were down this morning. We did see them fall as deep as about 1964 on the chart. Of course, we saw the breakdown at the end of September, followed by the massive rally. It was about $170, $180 on the upside. failed to take out this old swing high, which I was a little disappointed to see. But ultimately, this chart is still in very good shape, and we might potentially be seeing a correction in here. It looks like we are, and we could get as deep as 1930 on the downside, and this is still in very good shape and likely a buying opportunity on the way down before another resumption of the trend out into the end of the year and perhaps out into the early part of 2023. So keep all of that in mind. We do believe the U.S. fiscal situation is currently unsustainable. We did actually hear Jerome Powell also admit that the current spending levels in Washington, D.C. were unsustainable. I believe we ran a $1.5 trillion deficit in the fiscal year of 2023. Huge borrowing needs expressed by the Treasury last week out into the first part of next year as well. So very, very interesting to see that dynamic. And we do believe that all roads ultimately lead to gold, not only from a fiscal situation around the world, debt levels around the world, and of course the geopolitical climate that is red hot right now. So we're going to view all these pullbacks in gold, perhaps as deep as 1930, as buying opportunities. I am starting to get a minor oversold situation in here. Now we could get another wiggle back up in here. It cures the oversold, and then we get another breakdown into here, maybe back towards 1930, that presents a more better buying opportunity, I should say, for the gold market going forward. So that is a quick look at the market. Two markets, S&P and the gold market. Gave you a rundown of our market insight letter as well. If you want to jump on that market insight letter, feel free to ping me at jcaruso at rjofutures.com. I'd be more than happy to add you to that list for a 60-day trial, and we can go from there. Best of luck to everybody out there. Catch you back here next time.